There seem to be more pessimistic forecasts about our housing markets than there are positive property market commentators. But in today's Property Insider Chat, Dr. Andrew Wilson and I are going to share with you 10 reasons why we're still comfortable that our property markets are going to move forward strongly over the next couple of years. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can update you every time a new show comes out. 2022 has already turned out to be a fascinating year in real estate. Last year was unusual, where we experienced a once-in-a-generation property boom and values grew strongly almost everywhere. But now there seem to be more pessimistic forecasts about the short-term future of our housing markets than there are positive property market commentators. But if you've been watching our regular Property Insider chats, you'd know that we believe property values will still grow this year, but more slowly, and the markets are going to be more fragmented. But of course that's normal. But since the property pessimists are getting more than their fair share of headlines, today I want to chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, about 10 reasons why we're confident about our housing markets moving forward. Hi, Andrew.
Hello, Michael. And it is remarkable the consistency that we generate these fear campaigns over the prospect of housing market activity. And yet history tells us quite clearly that there is nothing to fear but fear itself. And I think we'll prove that truism will prove to be correct again for this year.
Now, Andrew, I don't want to minimise the horrors of war and the obvious humanitarian disaster that's occurring in front of our eyes, nor do I want to downplay the terrible effects of the floods in Australia or the effects supply shortages and rising global food prices are going to create in the developing world. However, today I'd like to concentrate on some of the good news that can easily get lost and why I am still, in fact I know we are both, confident about the future of our housing markets in Australia. And let's start with the fact that currently the average Australian is wealthier than they ever have been.
Well, of course, higher property values have worked into that. We always look at the proportion of debt that's increased, Michael, with house prices rising, because, of course, people have to borrow more in an aggregate sense to buy a house when prices are booming. And that's, of course, occurred, as you said, that once in a generation increase in prices last year has meant that there's been significantly higher levels of borrowings. But that's not really the story. It's firstly about the proportion of your repayments in terms of your average of your income. So if that's relatively stable, well, why wouldn't you borrow more if you're repaying proportionately the same level of your income? But the other end of the equation isn't debt, it's actually equity, as you mentioned. And if your assets are climbing strongly, it means your balance sheet is certainly in positive territory. And that's what we've seen. The wealth created by higher house prices has had a positive impact on household balance sheets. And that's the offset for debt. You just don't look at one side of the story. You've got to look at the full picture, which is debt versus assets versus the capacity to service your debt. And we're in a better position than we've ever been in terms of those measures.
Sure, well, it's suggested that there's a huge war chest of maybe even up to $230 billion in household savings. As you said, most homeowners have got significant equity. If they bought more than 2 years ago, many have got more than 30% equity in their home. Their share portfolio is doing well, their superannuation fund's doing well. And good point about the debt, Andrew, because while the overall property market's valued at close to $10 trillion, there's only about $2 trillion worth of debt. I'm saying only 2 trillion, but if you look at it, it's actually only a 20% loan to value ratio over the whole residential market. That's not a risky position at all, which makes me come to the next point that makes me feel confident, Andrew. There's no sign of mortgage stress for the majority of borrowers at present.
Yeah, what happened to the debt bomb, Michael?
I forgot about that.
Yeah, well, most people have, but that was a great story for a few years, wasn't it? The great debt bomb. I'm sure it'll be wheeled out again, and it was the cheapest of cheap headlines from those clickbait seekers. But yes, we do have very low levels as usual of mortgage defaults and also arrears. And of course, the important thing about mortgage defaults and arrears, Michael, is that they would typically follow the level or the labour market in terms of highs and lows. Of course, we now have the lowest unemployment rate since, just about on record for the series, but certainly the lowest since 2008. And of course, we know that we will start to see incomes rising, albeit perhaps gradually because of the nature of our wage setting system in Australia. But incomes are certainly on the rise, which means any issues with arrears and defaults are offset by increased incomes and the capacity to find work, because arrears and defaults usually increase as unemployment rises, and we're certainly going strongly in the opposite direction there. So yes, the debt bomb has become, I guess, a bomb of egg all over the faces of those that promoted it, but they got some headlines, so good luck.
Boy, didn't they? Well, it's suggested that many Australians are well ahead of their mortgage repayments. I was interested to read on the weekend that the ANZ Bank believe 70% of all its mortgage holders are well ahead in their mortgage payments. And it's estimated that there's $1.37 billion sitting in offset accounts or redraw accounts. And we also know that half of homeowners don't even have a mortgage. So there's no evidence of mortgage stress. And currently interest rates are low. And even if they do rise, and we know they will eventually, Andrew, I believe it would take 5.25% interest rate rises to bring them back to where they were 3 years ago. And there was minimal mortgage stress back then.
Well, we've discussed the prospect of higher rates in the outlook, Michael, and they still are dependent on higher wages.
Yep.
We're certainly a long way away from a consistent 3% plus annual increase in wages, which the Reserve Bank has used as its benchmark. I still think that's not going to occur, if it does occur, until next year, getting that consistency. We also have, as you said, the buffer on interest repayments. Mortgagees have a 3% buffer to cover the risk of higher interest rates. I'm not sure we're going to see an extra 3% anytime soon in interest rates, but the prospects for higher rates are still remote. But the offset to that is, firstly, higher rates would only come off the back of higher incomes. The Reserve Bank has told us that. So that would give, obviously, some capacity to absorb higher rates, which will only be incremental to start with, perhaps 0.25%. And the Reserve Bank would tread very carefully going forward. And the other point to that, you mentioned high savings levels, Michael. Saving levels are at near record levels at the moment, around about 15%. A savings ratio, which is below the record, but still very, very strong. So that gives households some capacity to absorb extra mortgage costs above their increased incomes. Well, I think that it's interesting, Michael, also when we speak about the debt of Australians in terms of the broader property market, we need to understand that around 40% of houses are tenanted, so they're not owner-occupiers, and of that 60% that remains, half of those actually own their own properties outright, so interest rates aren't a factor for them. And half of that 60% actually have very, very low levels of debt in their properties. And it's only the other half that have higher levels of debt and that are therefore exposed to higher interest rates or higher unemployment. And as we've suggested, both those factors certainly are negligible in the outlook in terms of creating any sense of mortgage stress. So we are only talking about a snapshot of Australian households that would be exposed to perhaps mortgage stress as a result of higher interest rates or higher unemployment. And it's not a sort of thing that's going to affect the whole of Australia's housing market. It's only that small snapshot that are affected.
Sure. Well, the investors, even though they're going to be affected, are going to be able to write it off as part of their negative gearing or tax benefits. So it's not going to cost them as much. And it really is going to be more the first home buyers who had to get into the market with high leverage. But in general, they'd rather eat Maggi noodles than sell up their home. So they're not going to end up selling up and making the property market crash, Andrew.
And they have the bank of mum and dad to rely on, and they have a queue of employers looking for workers at the moment. So seriously, it's not that hard to find a job at the moment, Michael, even if you're a first home buyer. And of course, we know also that the government promoting fiscal stimulus packages to offset high inflation. So that's another handout that households can use to offset higher interest rates if they come. Above all that, of course, we're certainly seeing the prospect of continued low unemployment and jobs growth, providing income for basically the workforce as a whole.
Well, that's another factor. Really, employment is strong, and that's because our economy is growing and it will continue to do so. And anyone who wants a job can get a job. Unfortunately, the issues overseas are creating havoc there, but it's going to increase our export income. And moving forward, our tourist income is going to improve as well now that our international borders are opening. So Australia's economic position and I guess our employment position is looking good moving forward.
Yes, Michael. And I think the big picture is we will be resuming mass migration. That's a commit both sides of politics or all political parties. Australia is a high migration country, and it's not just an economic proposal, it's also a cultural proposal that we embrace. And that means increased demand for housing, particularly. We already have a shortage of housing in this country. We only have to look at how rents are going through the roof at the moment to see that there's an emerging rental crisis in a number of cities, with tenants and prospective tenants being unable to secure shelter. And with a flood of migrants coming in, that will only exacerbate that problem. And of course, extra migrants will also help to moderate a shortage of labour as well. And this is all good news for our economy. And the other point is open borders will encourage tourism and business travel. And states such as Queensland, which have suffered through closed borders, will certainly resonate with the resumption of strong tourism, hopefully in prospect with open borders as well.
We've said it in previous chats, but it'd be wrong not to mention it again, that if you just look back at history, while lowering interest rates helped boost our property markets, rising rates didn't cause markets to fall in the past.
There's the history, as you said, Michael, shows us that even with a concerted increase in rates or over a concerted period, higher rates have only tended to have a lagging effect on house prices. It's taken some time for it to impact affordability. And that's because obviously higher incomes are part of what drives, and higher inflation are part what drives the RBA to act with higher rates. So it means that you can absorb those higher rates. And it only is at that point where affordability starts to fall because incomes aren't catching up with those higher rates, where you do see lower prices. But prices growth tends to just flatten rather than fall during a period of higher rates. And that has to be a consistent period, Michael.
And as we've already hinted, rents are going to be rising this year. There's a shortage of rental properties, which means it's more likely investors are going to be back in the market. And that's what we're seeing with finance figures as well. So investors will help underpin the market. And I think just the general wealth of the nation is going to continue the trend of upgraders. That's what drove the property markets last year. People just looking to upgrade their lifestyles in this new COVID normal environment.
And there's lots of interesting factors when we do look at buyer types, Michael. Firstly, as you mentioned, investors are surging back into property markets, keen to take advantage of capital growth, as well as those consistently relatively high yields that they're getting. With a shortage of rental stock, that will continue to put upward pressure on rents, and that will keep those yields reasonably stable. Of course, there is all those tax advantages that investors have. We still have investment activity below long-term averages, so there's plenty of upside for investor activity. And I would suggest that APRA this time, thankfully, won't be interfering with that rise in investor activity, which has certainly caused some significant issues, particularly on the supply side of housing markets, from those actions back in 2015 and 18. But the other point I think is interesting are first home buyers, Michael. First home buyer numbers have certainly eased over the last 6 months. No surprise, because first home buyers are the most exposed to higher prices because they don't have a trade-in to bring into the market. So they can't take advantage of a higher price for their trade-in. They have to rely on savings for their deposit. And of course, if prices are rising faster than savings, that's bad news for first home buyers. We don't have all the incentives we had a year ago for first home buyers as well. But first home buyer numbers, Michael, have actually perhaps surprisingly stood up over the last few months. And what I think we're seeing is the bank of mum and dad quite active in first home buyer activity, which hasn't fallen away as sharply as I thought it would with higher prices. And I think that's part of that intergenerational wealth shifting that's going on. Baby boomers, I guess, bringing forward their inheritance to their children and grandchildren in terms of keeping them in the housing market. And it's just that Australian regard for property as, I guess, a gold standard for as an asset class. And I think that's quite interesting for first home buyers. So I think we'll still see first home buyers very keen. They're always keen, but not. It's one thing just to be keen, Michael, but you have to have the pounds, shillings and pence, the dollars and cents to get into the market. And I think they're getting a leg up at the moment from their parents and grandparents just because of that regard of security in housing investment.
Well, one of the things the property pessimists are talking about at the moment, Andrew, is, hey, look at the statistics. They're showing that the Melbourne and Sydney property markets have been flat. And while overall they have, in my mind, it's a bit like putting one hand in a bucket of hot water and another hand in a bucket of cold water and saying, on average, I'm okay. But the markets are still in certain segments doing very well, aren't they?
Well, affordability has certainly constrained the Melbourne and Sydney markets. You just can't keep bidding up prices, going to the bank and asking for more and more money when there aren't either lower interest rates or higher incomes, which we haven't got. So those markets have run out of the capacity to push prices up, but sales volumes are still similar to where they were a year ago. And that shows that it's not just all about prices growth, Michael, it's also about turnover in the market. And turnover is still strong. Buyer and seller appetite is still at the burn time levels this year or similar to last year. But of course, the capacity because of affordability constraints isn't there to push prices up. However, of course, Brisbane and Adelaide are clearly more affordable markets than Melbourne and Sydney. So they have some way to go before they reach that threshold where affordability starts to bite in their capacity to push up prices. And other factors as well. We have a surge in migration, of course, continuing into Brisbane, which is helping to create increased demand compared to the other capitals. But, you know, with mass migration, international migration about to resume, that will stimulate demand, particularly in the Melbourne market, which is always a target for migrants. But again, it's all about the capacity to borrow more, Michael. So even if you've got a line of people looking to purchase a property and there's strong bidding, it's up to the bank whether or not you can borrow. And that means your incomes have to be rising, borrow more, or an interest rate would be falling to give you that capacity. So that's a good thing. It moderates the capacity of price growth, therefore moderating the outlook for house prices.
On balance, there are definitely headwinds ahead. We've got an election, which is almost certainly going to slow down market activity. It always has. There are overseas problems. There's always going to be the negative media. But on balance, there's more good news than there is bad news, isn't there?
Yes, well, we're coming up into April now, Michael, can you believe? And of course, April is the holiday month. So we have distractions anyway through April because of Easter, Anzac Day, etc. Easter is later this year, of course, which has had some implications for our auction markets. But also, I think that once the budget's out of the way and done and dusted, we'll also likely be commencing a lengthy election campaign, and that might occur through April. So that will exacerbate April as that holiday distraction month. We'll have the major distraction of an election campaign. So that will obviously impact certainty in a sense in parts of the housing market. But once these things are put to bed and we have a new government and the holiday season's behind us, the positives are all there, as you've so explicitly explained today, Michael.
We look at the weekend auction results every week as well, because it gives us a reasonably good indication of what's happening on the ground in time. And March finished off with positive results.
Yes, Melbourne and Sydney bounced back over the weekend, mid 70% auction clearance rates. Melbourne actually hosted its highest weekend for auctions for the year so far, Michael. We have the pre-Easter Super Saturday coming up in a fortnight. There will be big numbers coming through then, as we typically see. Of course, Sydney has been affected by the floods. That's now pushing behind it, and that was affected in terms of higher levels of withdrawals. It always, when you do get high levels of withdrawals, that has a downward impact on the clearance rate. But it's still very much a seller's market with those clearance rates in the mid-70s and a real sense of consistency this year, despite those seasonal ups and downs and those issues to do with the floods. And of course, earlier in the year, we still had issues with COVID. The Brisbane market's still down compared to a month ago, Michael, but again, we've seen higher levels of withdrawals in response to issues with the floods. But Adelaide and Canberra still quite strong, certainly off their peaks. But again, this just does reflect a maturing of the cycle. We've had a lot of pent-up demand now released, particularly in those smaller capitals. Auction markets are still very much a prime target for sellers, and they're finding robust results generally putting their houses up for auction or units up for auction.
Well, the markets will be tested over the next couple of weeks coming up to Easter, as there's going to be more properties for sale. But as we started off by saying, don't be too concerned about all the negative news. Yes, there'll always be issues out there, but we're very lucky that we live where we live at the times in which we live. And we're going to be able to look back at the end of the year and say, hey, look how strong our property markets have got through all these challenges.
We will say that, Michael, but we'll also be saying, we still have those negative stories fertilising our media.
No question about that at all. Okay, look forward to catching up with you again real soon, Andrew.